Now, next up is the settlement type. Now, what do you mean by settlement type? Is a settlement, a change in settlement happens when award that was originally meant to be settled in share is being settled as a cash, or vice versa. The standard treat this as a modification of the terms and conditions, which means it triggers accounting adjustments. So let's take the first case, the equity to cash. Now here you first of all de-recognize the equity component on the modification date, recognize the liability at fair value. Any difference between the two goes immediately to the P&L. But that's not the end, because since now it is cash settled, the liability must be remeasured at each reporting date until it is fully paid up. That means ongoing profit and loss volatility. It is very important to note here that if the amount of the liability recognized on the modification date it is less than the amount previously recognized as an increase in the equity, then that difference remains in the equity. One cannot reverse it through P&L. Second up is the cash to equity. It works slightly different. On the modification date, you de-recognize the liability on the at the fair value. Any difference and recognize equity at fair value on the modification immediately through the P&L. But once it is equity settled, there is no further remeasurement going forward. It is it is to be treated as equity settled, no remeasurement allowed. So the key takeaway is this: changing the settlement type has a direct and sometimes significant impact on both the balance sheet and the P&L. Equity to cash introduce recurring volatility, whereas cash to equity is one-time adjustment, but then remains stable. Now, this slide highlights some of the most common pitfalls that when the companies change the settlement type. The first one is misclassifying the awards when settlement terms change. For example, continuing to treat a cash settled award as equity, even though the company has committed to pay in cash. The impact is obvious: wrong accounting model, the misstated expenses, and potentially reinstatement risk. So, what should be done? Assess the classification carefully on the modification date and apply the correct treatment going forward. Now, the second pitfall is ignoring the modification date itself. This is the anchor date for measurement, and if it's overlooked, the liabilities get recorded at wrong value. The business impact is misstatement of liabilities and expense timing. So always identify the modification date and revalue it at fair value on that date. Another pitfall is failing to recognize the incremental fair value when liability is less than the equity. So, for example, if equity recognizes 100, but the liability is only 90, the 10%, sorry, the 10 rupee difference must be expensed immediately. If skipped, the expenses are understated and auditors will push back. So the rule is simple: any incremental fair value must straight go to P&L. Now, finally, skipping measurement is very common. Remember, cash settled award must be remeasured at each reporting date until they are settled. So if not, your risk is you risk under and or over provisioning and sudden P&L volatility jumps. And the fix is simple. The fix is to build the remeasurement into reporting calendar as a recurring step. That at each reporting date, it is being valued again. Now, a few consideration tie this up all together is Cash settled awards are liabilities and must be remeasured every period, whereas equity settled awards are expensed once and never remeasured, as discussed few minutes back. Second up is these employee incentives. Now, these changes directly impact how employees perceive the value of their awards, and conversation can help align interest with company performances. The third one is every change must be properly documented, disclosed in the financial statements. SEBI, Companies Act, accounting standard are very clear on this. So the big takeaway is that the settlement type changes are high stakes. They touch accounting, employee motivation, and compliance all at once. Companies that handle them with discipline, modification date, such as modification date, your correct classification, remeasurement, full disclosure, avoid both financial misstatements and governance risk. So with that, now I'll hand over it to my colleague Kashish, and who will walk you through the treatment of modification, cancellation, and settlement, and what are the recent volatility trends that we are seeing in the market. Kashish, over to you.
Thank you, Dribjot. Moving on to the next agenda item, which is the treatment of modification. So, as the name suggests, modification is any change in your policy or plan which results in an increase in the fair value or expense for the options that have already been granted. As per the accounting standard, the accounting standard clearly states that all the effects or all the details of the modifications are to be recognized and disclosed in your financials. This includes nature of modification, any effect which happens due to effect that happens to the fair value of the options that have already been granted, and also any incremental expense. So let's say if your fair value increases in this case, then the incremental expense need also to be calculated and recognized in your financials. Moving on to the types of modifications. Modifications can be basically two types. One is if they can be beneficial to the employees or the option holders, or they could be not beneficial to the uh, option holders. Also, modification can result in either change in the fair value of share-based payment. That means the uh, compensation per options that the employee is receiving changes, increases or decreases, or it could lead to the increase or decrease in the number of equity instruments that has been granted or will be exercised uh, to the option holders. Lastly, it can also have an impact on your vesting schedule or vesting criteria, which could be either be service linked or non-market performance. But yes, any change or any modification in your policy that have an impact will have to be recognized in your financials. So company has to take into consideration this. Now, what we will do is what I will explain an example of modification, that how it impacts your option pricing and how it impacts your accounting statement. In this example, we have taken a XYZ Limited company who have issued 1,000 ESOPs to one of its employees. The option price as on the grant date, since they are equity settled, the option price as on the grant date is 100 rupees. Coming to 30th September, basically after 9 months of grant itself, the company decides to modify the policy by reducing the exercise price. Obviously, within the boundaries of the Companies Act, like at Zidro stated, the exercise price cannot be lower than the face value. So within these boundaries, the company decides to modify their policy and reduce the exercise price. Since it's and this thing, because the exercise price is reducing, the amount of benefit that the employer will receive will be higher now. So the company has to calculate and account for the incremental expense that will arise due to this modification. And how will they do this? Is as on the modification date, which is 30th September in this case, they will have to recalculate what would be the option price had the modification not happened, or after the modification has happened. So when assuming a Black-Scholes model has been used, so all the other, in this case, the all the other inputs being the share price, the volatility, the risk-free rate, the term, and the dividend yield, all of these would be the same for pre-modification and post-modification. The only change would be the exercise price. Pre-modification exercise price would be higher, whereas the post-modification exercise price would be lower. So therefore, as you can see in this table, the pre-modification option price as on 30th September, the modification date comes out to be rupees 400, whereas the post-modification option price comes out to be rupees 500. So this difference of 100 rupees is the incremental fair value that the company has to recognize. Or so since there are 1,000 options that has been granted, so the total pre-modification fair value comes out to be 4 lakh rupees and the post-modification fair value comes out to be 5 lakh rupees. So the incremental charge is 1 lakh. This incremental charge is the total charge over here. So the company need not recognize the entire 1 lakh rupees as on the date of modification itself. This again will be bifurcated or expensed over the vesting period. So, for example, if the vesting period would have been 100% at the end of 1 year, so had only 9 months been passed from the date of grant, the company has to recognize only 75% of this incremental charge as on the date of modification, the remaining 25% over the remaining vesting period. So this is one of the important points that you have to take into consideration that as on the modification or as on the date of modification, the company has to recalculate whatever the incremental expense is there. In case there is no incremental expense or there is no increase in your fair value, then in that case, the company need not recognize any additional charge. Moving on to the pitfalls of the modification. The first pitfall or risk the company faces in case of modification is the unintended incremental expense. As I said, uh, because of the modification, if there is any increase in the expense or fair value, the company has to recognize this. If the company does not take into consideration that over here, then the consideration of this before the modification happens, then it could be a surprise for the company that after the modification, uh, the expense or the P&L impact has increased. So over here, what the company can do is either they themselves or they can ask their valuer to recalculate what would be the fair value after the modification and be sure that they are prepared to recognize this P&L charge in that financial year itself. The next pitfall or risk could be the detrimental modification device. So over here, Companies Act states that any modification that leads to that is detrimental for the option holding or leads to a decrease in the fair value cannot be processed by the company. So over here, the company has to ensure that any the modifications that they are doing will will be either will lead to no change in their fair value or an increase in the fair value for the employees. They have to avoid modifications that reduces the employee benefits. Okay, the next risk or the next pitfall over here is accounting complexity. So as I said, the disclosure asks the company to recognize and detail all the details of the modification in their financials. So any error in financial reporting could be a pitfall for the company. That during the audit process, this is a point that could come up that you have to follow the accounting standard and document all the assumptions and calculations regarding that modification. Coming on to key considerations, these are a few key considerations when after the modification has happened that the company should take into consideration. The first one is fair value recalculation. So as I said, as on the date of modification, the company has to recalculate what would be the fair value and what would be the incremental. Over here, one point to notice is the company only has to recognize the incremental expense. So in the previous example, the original option price was 100 rupees. The post modification offer price is 500. One could argue that should the company be booking the future expense on 500? Then that's no. The company has to recognize only the incremental. So 100 rupees of the original option price, which charge will still be recognized, and the incremental expense, which in this case is again 100 rupees, which is 500 minus 400 per option. So only these two charges are something that they have to utilize. They don't have to follow or recalculate the complete option price again and do the calculation based on the revised option price, which was 500. But yeah, they have to recognize only the incremental part of the fair value. The second consideration is the accounting treatment. So, as per disclosure, only those policy modifications are allowed that are beneficial to the employees or ESOP holders, and all the uh, accounting detail, all the required details are to be disclosed. The third is the measurement date. As I said, the recalculation of the incremental expense will be calculated as on the modification date and not on the as on the grant date of after any other date wherein the or balance sheet date. It would be calculated as on the modification date itself.